focused. Don't talk about what you're gonna do. Don't just dream about what you're gonna do. Don't criticize somebody else for what they're not doing. You be it. Be about it. Be about that action and go do it. Keep your eye on your intention.
When you are struggling and you start thinking about giving up, I want you to remember the power of hope, the belief that something better is always possible if you're willing to work for it and fight for it. Our hope that if we work hard enough and believe in ourselves, then we can be whatever we dream, regardless of the limitations that others may place on us.
If you stay in your comfort zone, that's where you will fail. You will fail in your comfort zone. Success is not a comfortable procedure. It is a very uncomfortable thing to attempt. So you got to get comfortable being uncomfortable if you ever want to be successful.
Excellence is never an accident. It is always the result of high intention, sincere effort, and intelligent execution. It represents the wise choice of many alternatives. Choice, not chance, determines your destiny.
You must know inside, in the deepest part of your being, that you matter. Not just that you matter, but also why. So for me, the foundational base of empowerment, of entrepreneurship, of any kind of engagement, the foundational base of my success, of my well-being, my wholeness, my everything is knowing who I am and where I come from.
Without commitment, you'll never start. But more importantly, without consistency, you'll never finish. Keep working, keep striving, never give up, fall down 7 times, get up 8. Ease is a greater threat to progress than hardship. So keep moving, keep growing, keep learning. See you at work.
I'm often asked, what's your secret to success? The shorter answer, put in that work. There may be more failures than victories. Please don't ever feel entitled to win. Just keep working harder. Surrender to the cards you are dealt. Losing can be the best motivator to get you even bigger wins. So never compare yourself to anyone else.
And I want to welcome each and every single one of you to the Fundamentals of Finance. It's an honor and a pleasure to have you here. If you don't already have something to write with, be sure to grab something so that you can take notes. There will be some valuable information shared. Again, if you have questions, there will be a live Q&A at the end. So you can put your questions in the chat and I'll do my best to answer your questions. So we're going to go ahead and get started. Here is just a little bit of information about me. I'm the founder of iTax Solutions and iTax Institute. In 2009, I launched a mobile tax preparation business. I did not go to college to learn how to prepare taxes or accounting or anything like that. It really just kind of fell into my lap. So thankful. Fast forward a few years later, I've grown this into a 7-figure tax firm. In 2019, I founded iTax Institute, and to date, I've trained over 500 entrepreneurs in launching a successful virtual tax preparation business. Some are also brick and mortar as well. I earned my bachelor's degree from UTA in 2010, earned my MBA from Texas University in 2012. I received an honorary doctorate last year in 2023, and I'm most definitely dedicated to uplifting others through financial education, business coaching, philanthropy, and much more. So I want each and every single one of you to know that if you ever need anything, you can always shoot an email or send me a message, like a private message. Whatever I can do to help, I'm here to help. So if this is your first time here, you may be wondering, what is the Fundamentals of Finance series? So the Fundamental of Finance series is a free webinar series that I designed to educate taxpayers as well as small business owners to navigate essential topics like taxes, business structure, funding, financing, and bookkeeping. I'm sharing what I've learned over the last 20 years as a business owner and a tax professional. And again, y'all, all of this information is free. So if you have a friend, a family member, a colleague, a business partner that you think may find some value in this information, be sure to share this. Next, who is this Fundamentals of Finance series for? This series is for anyone, whether you're a taxpayer, small business owner, or just someone looking to pick up additional financial knowledge, the stuff that they didn't teach us in school. I realized as my entrepreneur journey, continues, that a lot of the stuff that I've learned is not stuff that they taught me in high school. It's not stuff that they taught me in grad school or even undergrad for that matter. So a lot of this is just from experience and reading books, and also just, networking with different people so that I can get more experience. So I'm not going to gatekeep or anything like that. I'm not a gatekeeper if you know me. So I'm here to help in any way possible. Next slide. What should you bring to the Fundamentals of Finance series? It's simple. Just bring something to write with so you can take notes and refer back to them later, and come ready to learn with an open mind. I'm here to help make things practical and easy to understand. What is the objective of the Fundamental of Finance series? The objective here is pretty simple: to provide clear, accessible education on topics like taxes, business funding, and investments through a series of webinars. We're going to tackle a range of topics that would be helpful for anyone managing their own finances or running a small business. As the series progresses, I'll also be bringing in guest speakers who are experts beyond my own specialty. I know a lot about tax preparation, taxes, business taxes, but there are some things that I'm not very well versed in. So I'm looking forward to bringing in other experts that I know to educate each and every single one of you. So I'm looking forward to that. When is the Fundamentals of Finance series? So we're live every other Thursday at 7 p.m. Central. So mark your calendars and join us for the next session. So today is September 26th. So I think our next one is October 9th or October 10th. So at the end, you'll get the opportunity to go ahead and scan the code so you can register for the next one. Now, if for some reason you're late or you want to share this with somebody else, the replay will be posted on my YouTube channel. So you can always catch up or watch the replay. So here are a few rules before we get started. Please keep your microphone muted unless you're speaking. Avoid using any type of offensive or discriminatory language. If you have any technical issues, please use the chat to report them. Tony, she is my executive assistant. She keeps me on top of things, and she is making sure all of this comes together. So she will be monitoring the chat. So if you need something, be sure to put it in the chat, and she will get your question answered. Again, questions will be answered at the end of the presentation, and be sure to have your notebook ready to take notes. All right, so let's get started. This is Series 2 of the Fundamentals of Finance. Tonight, we'll be discussing the Earned Income Tax Credit, Child Tax Credit, Qualifying Dependents, as well as due diligence. So let's get into this. I'm excited. All right, so first we're going to start out with dependents. So in this section, I'm just going to cover, what dependents are, as well as some additional information. So a dependent is a person other than yourself. The term dependent means a qualifying child or a qualifying relative. So there are some tests that the IRS has implemented to determine whether someone is a dependent. So dependent taxpayer test: if the taxpayer can be claimed as a dependent by another person, he or she cannot claim anyone else as a dependent. Even if the taxpayer has a qualifying child or qualifying relative, he or she cannot claim that person as a dependent. If the taxpayer is filing a joint return and his or her spouse can be claimed as a dependent by someone else, the taxpayer and his or her spouse cannot claim any dependents on a joint return. So simply stated, if you are a dependent on someone else's tax return, you cannot claim a dependent. So there are 4 qualifying child tests: 1, relationship; 2, age; 3, residency; and 4, support. So we'll cover each and every single one of these. So the relationship test. So in order for someone to be a qualifying dependent on your tax return, the dependent must be your son or daughter. stepchild, an eligible foster child, adopted child, grandchild, brother or sister, half brother or sister, stepbrother or sister, or niece or nephew. So a dependent also must meet the age test. So a dependent must be under the age of 19 at the end of the tax year and younger than the taxpayer. So if you're planning to claim a dependent on your 2014 taxes, your upcoming taxes that we'll be filing starting in January 2025, then they must be under the age of 19 as of December 31st, 2024, or a full-time student under the age of 24 at the end of the tax year. So a lot of times taxpayers have children, right? And I get clients all the time and they're like, hey, you know, my kid is in college, they're going to file their own tax return. And what I prefer to do, my clients that have children, we file your taxes for free for your child if they're in college. But what a lot of people don't realize is if your child is in college, even if they're no longer in the household, you can still actually claim your child as a dependent on your taxes as long as they're under the age of 24 and they are in college. So even if they're not in the home and they decided to go off to school in an entirely different state, you can still actually claim them as a dependent. Also, you want to make sure if that child is in college, that they receive their Form 1098-T. A lot of parents are not familiar with that form. So what that form reports is the amount of scholarships or grants, as well as the out-of-pocket expenses that a taxpayer pays for college. So you can actually receive up to an additional $1,000 on your tax return if your child is a full-time student, they go to college, and they receive that Form 1098-T. So as soon as I see that, you know, a taxpayer has a kid that's, you know, between the ages of 18 and about 23, 24, I always ask, hey, are they in college? And if so, you know, let's go ahead and get that form so that that can actually increase the refund amount for the taxpayer, because we all know college is very expensive. I'm definitely learning that now that my daughter is in her third year of college. So I need all that I can. So a dependent must also be, let's see, you could go back. I'm sorry, I missed the last one. Permanently and totally disabled at any time during the tax year, regardless of age. So if you have a dependent that is in your home that you're taking care of and they're permanently and totally disabled, so this has to be deemed by a doctor, right? You can't just say like, oh, my cousin is, you know, or my family member is disabled. No, they have to be disabled, considered disabled by a medical professional. So it doesn't matter what age they are, but as long as they're permanently and totally disabled, then you can claim them as a dependent no matter what age they are. So next we have the residency test. The dependent must have lived with the taxpayer for more than half of the tax year. So 6 months or more, the dependent must live in your home. Again, if they're a college student and, you know, they went off to college, your home is still considered their main home. So you can't claim someone if they only lived in your house for 3 months. It has to be 6 months or more. And it doesn't have to be 6 consecutive months. It just has to be 6 months. Support test. Dependent cannot provide more than half of their own support. So basically what that means is that a dependent cannot claim more than half of their own support. So for instance, if you are claiming a dependent on your tax return, and let's just say, you know, maybe your child is, I don't know, maybe 19 years old, maybe they're not, you know, in college, but they made, you know, $20,000, right? The IRS is going to look at that and say, okay, at about 20 grand, you know, this taxpayer, this individual can care for themselves, right? Now, if their income is below, I want to say 5,000 for 2024, I think it's $5,050, then you can claim them. And we'll get more into that later on in the slides, but the dependent cannot provide more than half of their own support for the tax year. So here are some expenses that are considered support expenses, basic things: food, clothing, education, lodging, transportation, medical and dental expenses, any expenses that are necessary to live. some expenses that are not included as support expenses include taxes, life insurance premiums, scholarships, or scholarships received by the dependent. Sometimes a dependent can meet the relationship, residency, and support test to be a qualifying child of more than one taxpayer. Only one taxpayer can actually claim the child as a qualifying child and take all the tax benefits. It's always the taxpayer with the higher income. So sometimes I've seen situations where there are two taxpayers who are like, you know what, we both want to claim, this dependent. Well, there is, what is it called? It's called a joint. What is that test called? The tiebreaker rule. That's what it's called. The tiebreaker rule. So the IRS has a rule. It's called the tiebreaker rule. And if two people are saying, hey, you know what? I took care of this person. I took care of this person. The IRS says, okay, well, you know what? There's no reason to fight about it. The taxpayer who has the higher income is going to be able to claim the dependent. And the reason why the IRS wants us to do that is because quite naturally, if the taxpayer with the higher amount of income claims the dependent, that means that that's less tax liability, or actually more tax liability for that particular taxpayer. So if they allow the person who has the lower income to claim the dependent, that means the IRS would basically have to pay out like a higher tax refund amount. Next slide. Qualifying relative tests. 1, not a qualifying child. 2, relationship or member of household. 3, gross income. And 4, support. So we'll cover each and every single one of those. First, not a qualifying child. A child is not the taxpayer's qualifying relative if the child is the taxpayer's qualifying child or the qualifying child of another person. So basically, if the dependent is a qualifying relative of someone else, they can't be a qualifying child of another person. Simply stated, a dependent can only be claimed by one person. Relationship or member of household. To meet this test, a person, qualifying relative, must either live with the taxpayer all year or be related to the taxpayer, child, grandchild, brother, sister, father, mother, grandparent, niece, nephew, uncle, aunt. A cousin can only be claimed as a dependent if he or she lived with the taxpayer all year. Gross income. A person's gross income must be less than a certain amount. So for 2023, you could claim a dependent if they made less than $4,700. Now for 2024, you can claim a dependent as long as they made less than $5,050. Now y'all see with inflation that, went up, what is that, around $350? Also, you'll see later on how the credits also went up around the same amount. I want to say starting in 2018, I think starting in 2018, maybe a little bit before, that's when we started seeing things go up like every single year significantly. Also, unemployment compensation is included and Social Security is excluded. Support. A taxpayer must provide more than half of the person's total support for the tax year. What's the difference? So here's a comparison of a qualifying child versus a qualifying relative. So these are, let's see, the different filing statuses as well as credits that you're able to claim for these certain qualifying relatives or qualifying children. Next slide. So here's a brief summary of everything that we covered. Once we summarize everything, we are going to get ready for a quiz. So y'all get ready. I hope you guys are paying attention and y'all are ready to answer these questions. So in summary, a taxpayer cannot claim any dependents if they can be claimed as a dependent by another taxpayer. A taxpayer cannot claim a married person who files a joint return as a dependent. A taxpayer cannot claim a person as a dependent unless that person is a U.S. citizen, U.S. resident alien, U.S. national, or resident of Canada or Mexico. A taxpayer cannot claim a person as a dependent unless that person is your qualifying child or qualifying relative. So to be a qualifying child, the child must be the taxpayer's son or daughter, stepchild, foster child, brother, sister, half-brother, sister, stepbrother, stepsister, or grandchild. Those relationships are important to remember. The qualifying child must be under age 19 at the end of the tax year and younger than the taxpayers. Under age 24 at the end of the tax year, a student and younger than the taxpayers. Any age if permanently and totally disabled. The child must have lived with the taxpayer for more than half the year. The child must not have provided half of his or her own support for the tax year, and the child must not be filing a joint return for the year unless they are getting a refund of income tax withheld or estimated taxes paid. Lastly, the person must be related to you, live with you all year as a member of your household. The person's gross income for the year must be below a certain amount. As a reminder, for 2024, that amount is $5,050, and the taxpayer must provide more than half the person's total support for the year. Yay, it's quiz time. So y'all be sure to get into the chat. All right, put your answers in the chat. We're going to go ahead and get started with question number 1. Which of the following best describes the term dependent? A person who earns their own income. B, a person who is either a qualifying child or a qualifying relative. C, a person who is not related to you. Or D, a person who is older than you. Okay, so let's see what we have in the chat. We got B, B, B. Okay, looking good, looking good. Okay, the answer is B, a person who is either a qualifying child or a qualifying relative. So yay to everybody who answered B. Next question. Question number 2, which of the following is true regarding a taxpayer's ability to claim dependents? A taxpayer can still claim dependents if they are claimed as a dependent by someone else. B, a taxpayer can claim a dependent as long as they have a qualifying child or relative, even if they are claimed as a dependent by another person. C, if a taxpayer is filing a joint return and their spouse could be claimed as a dependent by someone else, they can still claim dependents. Or D, if a taxpayer can be claimed as a dependent by another person, they cannot claim anyone else as a dependent. I'm going to give y'all just a second. Okay, I see D in the chat. D in the chat. D. All right. Okay, let's take a look and see what the answer is. The answer is D. So if you answer D, that's correct. If a taxpayer can be claimed as a dependent by another person, they cannot claim anyone else as a dependent. I'm so excited. All right, y'all are paying attention and getting these right. Nobody's gotten one wrong so far. This is awesome. Question number 3, which of the following is a requirement for someone to be considered a dependent for tax purposes? A, under age 19 at the end of the tax year. B, a full-time student under the age of 30 at the end of the tax year. C, permanently and totally disabled at any time during the tax year, regardless of age. Or D, under age 24 at the end of the tax year and older than the taxpayer. So that one's a little tricky. Okay, maybe not so much. Okay, we have C, 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 okay, in the chat. All right, Tony, let's take a look. What's the answer? C, that's correct. Y'all got that right. Permanently and totally disabled at any time during the tax year, regardless of age. Awesome. Question number 4. If a dependent meets the relationship, residency, and support test to be a qualifying child for more than one taxpayer, who can claim the child for tax benefits? A, both taxpayers can claim the child and share the tax benefits. B, only the taxpayer with the higher income can claim the child. Or C, neither taxpayer can claim the child if they both meet the qualifying test. B, okay, I see a lot of B's in the chat. All right, answer. Yay, B, y'all all got that correct as well. B, only the taxpayer with the higher income can claim the child. All right, next question. Number 5, for a taxpayer to claim a child as a dependent, how long must the child have lived with the taxpayer during the year? A, the entire year. B, more than 6 months. C, less than half the year. Or D, exactly 6 months. Okay, B, I see a lot of answers for B. So if you answered a B, that is, let's take a look at the answer. That is correct, more than 6 months. Yay, y'all are doing so good. Okay, question number 6. To qualify as a dependent for tax purposes, a student must be under what age at the end of the tax year? A, 18, B, 21, C, 24, or D, 26? Okay, I see 24 in the chat. I see C. Okay, yep, looking good, looking good. Y'all are getting all of these right. This is awesome. So the answer is C, age 24. Next question. What is the maximum gross income limit a dependent can earn during the 2024 tax year? A, 4,700, B, 5,050, C, 5,500, or D, 4,900? I see a lot of B's in the chat. Okay, all right. I'm so excited, y'all. Y'all know how excited I am. Okay, that is absolutely correct. B, $5,050. So for 2024, a dependent, if they earn less than $5,050, the taxpayer can claim them. Next question. Which of the following are considered support expenses? A, food, clothing, and education. B, lodging, transportation, medical expenses. C, necessary expenses to live. Or D, all of the above. Okay, I see D's in the chat. All right, perfect. All right, let's take a look at the answer. D, all of the above. That is correct. Okay, so here's a brief tax scenario. Mia's 18 years old. She lived with her mother for 10 months during the tax year and did not earn any income during the tax year. Mia married John on December 27th of the tax year. John is a general manager at a grocery store. He earned $36,293 during the tax year. Mia and John agreed to file a joint return. Can Mia's mother claim her as a dependent? Yes or no? So the fact that Mia is 18, even though she lived with her mom during the tax year, if she got married, so according to the Internal Revenue Services, whatever your marriage situation is on December 31st is basically what's considered your whole situation for the entire tax year. So if she got married on December 27th, on December 31st, obviously she was married. And if she agreed to file a joint tax return with her husband, then Mia would be a taxpayer on the tax return with her spouse. Now, sometimes, so that means that her mother cannot claim her as a dependent. Now, sometimes, a lot of times I'll hear this, people will say, well, you know, my spouse doesn't work. Can I claim my spouse as dependent? So from a tax standpoint, no, you cannot claim your spouse as dependent, because what the IRS can do is they can, ask you for like marriage records and that kind of thing. So even if the spouse does not work, they should be filing joint tax return and claiming, the dependents if they have dependents, but you cannot claim a spouse as a dependent. And in this situation, Mia's mother would not be able to claim her as a dependent because she got married and she agreed to file a joint tax return with her husband. Next slide. So now we're going to get into the earned income tax credit. All right, so what is the EITC? The Earned Income Tax Credit helps low to moderate income workers and families get a break. If you qualify, you can use the credit to reduce the taxes you owe and increase your refund. So when we talk about reducing the taxes you owe, basically how I refer to that is reducing your tax liability. So the more your tax liability is reduced, the more your refund amount is. So who qualifies? If your income is low to moderate, you may qualify. The amount of credits may change if you have children, dependents, are disabled, or meet other criteria. If you worked and earned income under $59,899 and your filing status is single or head of household, or if your filing status is married filing joint and combined you guys made $66,819, you may qualify for the earned income tax credit. You also, to qualify for the earned income tax credit, they say, hey, you have to have investment income below 11,600 for 2024. I want to say for 2023, I think it was 11,000. So each year, we'll also see the earned income amount to actually go up as well, because again, with inflation, people are making more money. So you'll see these income limits kind of continue to rise. But as we go, if you could go ahead and advance to the next slide, but as we get a little bit deeper into this, you'll see that the credit actually phases out the more that you make. So sometimes what you'll see is if a taxpayer has a lower income, so if their income is maybe like $20,000, they're going to receive more of the earned income tax credit versus a taxpayer who made $55,000. So again, as you make more money, the credit, phases out. Next slide, please. So who qualifies? You must have a social security number by the due date of your tax return, be a U.S. citizen, and not file Form 2555. Earned income includes all the taxable income and wages you get from working for yourself, for someone else, or from a business or farm you own. This also includes rental income as well. So if you have rental properties or anything like that, that's also considered earned income. So here's a list of types of earned income: wages, salaries, tips that are reported on your Form W-2 that are in box 1. Income from a job where your employer didn't withhold taxes. So if you're driving for Uber, running errands, if you have some type of, side hustle, services that you're offering, anything like that, self-employed, owner operated business or a farm, or a minister, statutory employee, benefits from a union strike, certain disability benefits, and non-taxable combat pay as well. Earned income does not include pay you got from work when you were an inmate in a penal institution, interest and dividends, pensions or annuities, Social Security, unemployment benefits, alimony, or child support. A lot of times I do receive the question, do I have to report my child support or alimony on my tax return? No, you do not. That's not considered earned income. The EITC is calculated as a percentage of your earned income. As your income increases, the credit amount rises until it reaches a maximum, then begins to phase out at higher income levels, which is basically what I just said a moment ago. So, if you are wondering where the earned income tax credit is reported on your tax return, so the IRS, as of today, has not released the 2024 1040. So I'm going to show you exactly where this is reported on your 2023 tax return if you want to pull out your tax return and take a look at it later. Or, of course, if you just want to know exactly where this information is, a lot of times I'll get clients and they'll ask me, how much money did I receive for, the children, right? If they're receiving the earned income tax credit. So that is actually located on page 2 of the 1040, line 27. It says earned income credit. So it's in the payment section. So it's on line 27 is where the earned income tax credit is reported. So that will tell you exactly how much money you received for, the dependents that you're claiming on your tax return. How does the EITC affect my tax refund? And I also want to clarify as well. So a lot of times so your refund, right? Your tax refund is the actual amount that you receive when you file your taxes, right? And your tax return is the actual documents or the actual papers that you receive, your 1040, as well as all of the supporting schedules. So I just kind of want to clarify that sometimes, people kind of get the words a little confused, but the tax refund is the actual amount of money that you receive, and the tax return are the actual documents that you have that make up your tax return. So Reduction of tax liability. The EITC reduces the amount of tax you owe on a dollar-for-dollar basis. If your EITC exceeds your tax liability, you will receive the difference as a refund. For example, if you owe $1,000 in taxes and qualify for a $1,500 EITC, you will receive a $500 tax refund. Next slide. So I use a professional tax software, so I don't personally calculate, pull out a pen and paper calculator and calculate all of this stuff. And whether you get your taxes prepared, with a tax professional, or if you use something like, like a DIY service like TurboTax or something like that. The good thing about these things is that, it calculates everything before. Now, I will say when I learned how to prepare taxes in 2008, 2009, I literally took a 12-week course with a calculator, with a pencil, and an eraser. So I was really doing it the old school way. That was when people were filling out their tax information and mailing it in so long ago. So I'm so thankful that this software does everything it needs to do. Back to business, refundable credit. The EITC is a refundable credit, meaning that even if you do not owe any taxes, you can still receive a refund if you qualify for the credit. This makes it especially beneficial for low to moderate income workers. So there are refundable and non-refundable credits. This is a refundable credit, which basically means that it will increase your refund. The amount of EITC you can claim varies based on your income, marital status, and number of qualifying children. As your earned income increases, the EITC amount rises until it reaches a maximum, after which it begins to phase out as your income continues to increase. So here are the income limits for EITC. And y'all, this information is always publicized on the IRS website. You can go to irs.gov and you can type in like EITC and it'll give you these tables, right? So you can always go and look at this information. So for 2023, so here in this table, what we see is the number of qualifying children in the furthest to the left column. And then next we see the different filing statuses. So we're kind of comparing 2023 to 2024. So these are basically the income limits that you have to meet in order to receive the earned income tax credit. So even if you don't have any children, right, and you make under, for 2024, if you make under $18,591, you can still actually receive some earned income tax credit, right? I want to say it might be, I think we have it on another slide, but it might be around $600 for one child. If you are filing, head of household and you have one qualifying child in 2024, the maximum that you can earn for 2024 is $49,084. Two children, $55,768. Three or more, $59,899. Also, we have the table for married filing joint. So here on this next slide, what we have. So on this particular example, what I wanted to show you all was this is an example of someone who they file their taxes and it's a married filing joint couple. They have two children, and you can see on line 27 where it has the earned income credit, and that amount is $6604. So on page 2, line 27, you can see that that income, I'm sorry, not the income amount, but the earned income credit amount is $6604. Now for 2023, that was the maximum that you could receive. And also you will see line 35A and 34 that tells you the actual refund amount. So when you see that that amount on line 27 is like the maximum for that particular year, then you know that you received the maximum credit. Now, again, you do have to meet the income limit. So this particular couple, they made less than the 2023 income limit. So to combine, they made $34,000. So basically that means that they qualified. Next slide. Okay, here you'll see that this individual is a her filing status is head of household. She has one child. And on page 1, line 1, you'll see that she made $91,061, right? So her income amount exceeds the amount for 2023. So when you go to line 27, you will see that that is empty. So that means that she did not receive the earned income credit, right? Because she didn't qualify. So you'll also see that, you know, her refund amount was roughly about $2,500. But again, I just kind of wanted to show you guys where that line 27 is. So next slide. So you'll notice that for 2023, it is on line 27. Now, sometimes the 1040s will change. So just make sure that, you know, you just kind of read over it for 2024. Here are the limits, or the maximum credit amounts for 2023 as well as 2024. For 2024, it looks like for no qualifying children, it increased about $32 to $632. For one qualifying child, it was for 2024, it's $4,213. For two qualifying children, $6,960, and for three or more, $7,830. Now, just kind of based on my experience, you know, tax refunds will probably, you know, just kind of go up slightly, not too much. Most of this is not really that much of a difference. You may see a higher refund. Now, I say you might see a higher refund that's just a couple $100, only if, like, let's just say, for instance, you made almost like the exact same amount of money that you did last year and got the exact same amount of taxes withheld as the previous year. That usually doesn't happen with a lot of people, but, you know, it looks like they went up a little bit, so it's a good thing. So remember, a taxpayer can claim up to 3 children to claim the EITC. So if you have more than 3 dependents, I tell my clients all the time, you can list them on your tax return, but you will not receive any earned income tax credit for those children, right? And it's so interesting because, you know, I have clients with multiple children, and you know, I have one client, she has like 5 children, and she claims we list every single one of her children on, you know, her dependent on her tax return. But again, she doesn't receive the earned income tax credit, because if you don't list them on there, there's a possibility if someone else, you know, gets their social security number, their personal information, that they can claim them as a dependent. So even if you have more than, you know, 3 children, you want to still put those children, you know, on your tax return to ensure that no one else claims your children. Next slide. So here's just a brief little table that is included that goes over qualifying children, the ages, all of that good stuff. So we can advance to the next slide. I think I kind of already went through that. I went through that as well. Next slide. Here is the form, Schedule EIC. So if you have dependents, you'll see this. It'll list your children's name, their year of birth. As tax professionals, when you're doing your due diligence, what we have to do is we have to answer these questions. Basically, the IRS holds us accountable and says, hey, you got to ask the taxpayer these questions. And that's also very important. So whether you're going to a tax professional or you are filing your taxes yourself, always make sure that you have the supporting documentation that you need. Also, make sure that your tax professional asks you for the supporting documentation that they need, such as birth certificates, social security cards. I know for us, our returning clients, we don't ask for social security cards and birth certificates every single year. But we do ask for, you know, school records, right? The IRS wants to see that the child or the dependent that the taxpayer is claiming, they reside with the taxpayer, right? So proof of that may be a school record, right? Maybe a report card showing the dependent's name as well as the address on the report card. So as long as that address matches what is on the tax return, then you're good. Also, when you're claiming the head of household filing status, your tax professional should be asking you for a utility bill or a lease agreement, or if you own your home, then your mortgage statement, that will suffice as well. But I would tell y'all this, my experience with the Internal Revenue Services, these last couple years, once they like crunk it up and hired all these people, like these people are literally like doing their job. They're sending out letters left and right to taxpayers who have been claiming their children for years, saying, hey, we're going to disallow this credit. You need to send us over you need to send us supporting documentation. They don't necessarily tell you what you need to send them, but they do kind of send you a schedule that says, hey, this is acceptable, documentation that you can send over. So they send out all these letters to people hoping that you're not going to respond or you don't have the documentation. And then they'll say, okay, well, hey, you know what? Those 3 children that you claim, that earned income tax credit that we gave you, now you owe us this $7,000 back, or you owe us this $8,000 back, or $5,000 back. So you always want to make sure that you keep your documentation. I've also had people come to me that had another tax professional prepare their taxes, and then they're in a bind and they're like, oh, let me call Ambria, right? Which is fine. I don't have a problem with that. But sometimes those, you've had tax professionals who will go ghost on you, right? And you get this letter and you're freaking out and you're not responding. So it's important so that, as a taxpayer, you understand how to respond to these letters in the event that you prepare your own taxes or your taxpayer ghosts you. You have all this information. So don't ever be like freaked out if you get a letter from the IRS. I know it can be really, really scary, but even though they are a government entity, I get it, but I promise you there's a solution to every single problem. They're just kind of trying to rattle people up so they can get some money. Next slide. You are eligible to claim the EITC without a qualifying child if you meet all the following rules. You and your spouse, if you file a joint return, must meet the EITC basic qualification rules, have your main home in the U.S. for more than half the tax year, or not be claimed as a qualifying child on anyone else's tax return. Be at least 18 at the end of the tax year. If you are a specified student, you need to be oh, wait a minute. I think I just got completely off. Be at least 18 at the end of the tax year, usually December 31st. The minimum age to claim the EIC is generally age 19. However, if you're a qualified former foster youth or a qualified homeless youth, you need to be at least age 18. If you are a specified student other than a qualified former foster youth or a qualified homeless youth, you need to be at least age 24. And this is just straight from the IRS, y'all. Quiz time. All right, y'all got them all right last time. Let's see what we do this time. I don't think there are as many quiz questions for this particular section, but there are a few. So let's get started. Be ready to put your answers in the chat. Question number 1. What is the purpose of the Earned Income Tax Credit? A, to help high-income workers reduce their taxes. B, to provide financial assistance to retirees. C, to help low to moderate income workers and families reduce taxes and potentially increase their refund. Or C, allow taxpayers to claim dependents on their tax returns. Okay, let's see what we have in the chat. All right, Andrea said C. C, okay, everybody's saying C. All right, answer is C, that's correct. To help low to moderate income workers and families reduce taxes and potentially increase their refund. Next question, which of the following is a qualification for earning certain tax credits for the tax year 2024? A, worked and earned income under $70,000 as a single or head of household. B, have investment income below $15,000 in the tax year 2024. C, worked and earned income under $59,899 as single or head of household, or under $66,819 as married filing joint. Or D, have no investment income in the tax year 2024. If you answered C, that's correct. Worked and earned income under $59,899 as single or head of household, or $66,819 as married filing joint. Yay, congratulations. All right, question number 3. How is the earned income tax credit calculated for a taxpayer? A fixed amount based on the number of children. B, as a percentage of earned income increasing to a maximum and then phasing out at higher income levels. C, as a flat rate based on total income. D, as a reduction of income tax owed regardless of earned income. Okay, that is correct. I see a lot of B's in the chat. So the answer is B. As a percentage, what was it? As a percentage of earned income increasing to a maximum and then phasing out at higher income levels. Thank you. Next question. What is the maximum number of children you can claim the earned income tax credit for? A, 2, B, 3, C, 4, D, 5. Okay, I see the number 3. I see the letter B. Let's take a look at the answer. If you answered B, 3, that is correct. Next, we have question number 5. Which of the following is not a type of earned income? A, wages, salary, or tips reported on Form W-2. B, income from self-employment or gig economy work. C, benefits from a union strike. Or D, interest income from a savings account. Which of the following is not a type of earned income? I see C, I see D. Wait a second. I see both C and D in the chat. Okay, the answer to question number 5 is D, interest income from savings account. That is not considered earned income. Question number 6, is the earned income tax credit a refundable credit? Yes. I'm sorry. A, yes. B, no. C, only for certain income levels. Or D, only if you have children. Is the earned income tax credit a refundable credit? So we have refundable credits and non-refundable credits. Okay, so let's take a look at the answer. The answer is A, yes. So we have refundable credits and non-refundable credits, and the earned income tax credit is a refundable credit. So it's a kind of bit of a trick question. It was either really a yes or no. I think my teammate have just kind of threw those other answers in there to kind of throw a little loop. But yes, the answer is A. Question number 7. Which of the following is not a requirement to claim the earned income tax credit without a qualifying child? A, you and your spouse, if filing jointly, must meet the EITC basic qualification rules. B, you must have your main home in the U.S. for more than half the tax year. C, you must be claimed as a qualifying child on someone else's tax return. Or D, you must be at least 18 at the end of the tax year if you're a qualified former foster youth or homeless youth or qualified homeless youth. That was a mouthful. Okay, I see A, I see C, I see D. Okay, let's take a look at the answer. The answer is C. You must be claimed as a qualifying child on someone else's tax return. So if you answered C, you got that correct. Next, okay. So those were all the questions for EITC. Next, we're going to move on to the child tax credit. The child tax credit is a non-refundable credit for taxpayers who have a qualifying child. For tax year 2024, the TTC is worth up to $2,000 per qualifying child, and the refundable portion of this credit is $1,700. To qualify for the CTC, you must meet several criteria related to the child's age, relationship to you, residency, support, citizenship, and your income. Now, for 2023, the CTC was also $2,000, but the refundable portion was only $1,600. Now, also what you notice, the EITC was refundable and the CTC is non-refundable. The eligibility requirements: age, the child must be under 17 at the end of the tax year. Relationship, the child must be your son, daughter, stepchild, foster child, sibling, or a descendant of any of these. Dependent status, you must claim the child as a dependent on your tax return. Residency, the child must have lived with you for more than half the year. Support, you must have provided more than half of the child's financial support. Citizenship, the child must be a U.S. citizen, national, or resident alien with a valid social security number. Income, your modified adjusted gross income must be below a certain threshold. So if you're single or head of household, you must make under 200,000. Married filing joint is 400,000. Now, what I want to also kind of point out with this, even for some individuals may have an ITIN. It is common. Some individuals may not have a social security number. So you can also, if you have an ITIN, you can also file taxes, and you can also file dependents that have an ITIN on your tax return. Now, the thing about having an ITIN is that you don't receive as much credit as someone who has a social security number. So I just kind of thought about that when I read valid social security number. So that's important. And remember, the modified adjusted gross income has to be below 200,000 for single and head of household, and below 400,000 for married filing joint to receive the full credit. Next slide. The additional child tax credit. If you end up owing less than the amount of the CTC, you may be able to get a refund using the additional child tax credit. The ACTC is refundable for the unused amount of your child tax credit up to $1,700 per qualifying child for 2024. The amount of your child tax credit will be reduced if your adjusted gross income exceeds $400,000 if married filing jointly, or $200,000 for all other tax filing statuses. For a child to qualify for the child tax credit, they must meet the following conditions. The child is the son, daughter, stepchild, eligible foster child, brother, sister, stepbrother, stepsister, half-brother, half-sister, or descendant of any of these. The child is under age 17 during the tax year, and the child did not provide over half of their support. So these credits are basically calculated, within the tax software. So you will see on the 1040 form on that second page as well. And I think that we point that out here in this presentation tonight, where that's actually reported. The child lived with the taxpayer for more than half the tax year. The child is claimed as a dependent. The child was a U.S. citizen, U.S. national, resident alien, or adopted by a U.S. citizen, U.S. national, or U.S. resident alien. So here you will see this is line 26 of a 1040 for tax year 2023. And this is actually reported on line 26, the additional child tax credit. So the EITC is reported on line 27, and the additional child tax credit is reported on line 28. My apologies, I said 26. The additional child tax credit is reported on line 28. So quiz time, let's go. All right, y'all ready? Let's get in the chat, get these right, get them right. What is the maximum amount of the child tax credit for tax year 2024 per qualifying child? A, $1,600, B, $2,000, C, $1,000, or D, $2,500? Okay, I see B. All right, let's take a look at the answer. The maximum amount is B, $2,000. Yay to everybody who answered B. That is correct. What is the modified adjusted gross income threshold for single filers to receive the full credit? A, 100,000, B, 200,000, C, 300,000, or D, 400,000? What is the maximum what is the modified adjusted gross income threshold for single filers to receive the full credit? Okay, I see B in the chat. All right, the answer is B. Correct, 200,000. All right, y'all are really on top of this. Question number 3. What is the maximum refundable amount for the additional child tax credit for 2024? A, 1,000, B, 1,400, C, 1,700, or D, 2,000? I see C. I see B. Okay. The answer is C, 1,700. And as a reminder, for 2023, it was 1,600. Question number 4. Which of the following is not a requirement for a child to qualify for the child tax credit? A, the child must be the taxpayer's son, daughter, or descendant of any of these. B, the child must be 18 years old or younger during the tax year. C, the child must not provide more than half of their own support. Or D, the child must be claimed as a dependent on the taxpayer's return. Which of the following is not a requirement for a child to qualify for the child tax credit? Okay, I see B, I see C. The answer is B. The child must be 18 years old or younger during the tax year. Next slide. So next we have the other dependents credit. I'm going to go over this briefly. Taxpayers with dependents who don't qualify for the child tax credit may be eligible for the credit for other dependents. This credit is non-refundable, meaning it can reduce your tax bill but won't result in a refund if the credit exceeds your tax liability. Now, the maximum for the other dependents credit is $500 for each dependent. So eligibility criteria for the credit for other dependents. So qualifying dependents. The ODC is designed for dependents who do not qualify for the child tax credit. This includes dependents who are age 17 or older at the end of the tax year, adult dependents such as children or relatives who may be disabled or elderly. So dependents who are age 17 or older at the end of the year. Right. So sometimes what happens, you always want to specify. So within our professional tax software, we have to specify, sometimes, there are dependents who may be age 18 or 19 that are still in high school. Now, it's important that you let your tax professional know about that. If your child is like 18 or 19 and they're in high school, that will make a big difference. Adult dependents such as children or relatives who may be disabled. If you have somebody that you're claiming as a dependent who's over the age limit and they are disabled or they're elderly, you can get that additional $500. Sometimes, I've had clients who have children that are still in their home and maybe they're 20, 21 or something like that, and they're not working. They're not earning any income, but they are still in their parents' home. So sometimes, that those are some of the individuals or the situations I see where this credit comes into play for the additional $500. Dependents with individual taxpayer numbers, which is the ITINs that I just kind of spoke about. 2, relationship. The dependent must be a qualifying relative or a qualifying child. This includes parents, grandparents, siblings, and other relatives who rely on you for support. Children who do not meet the age requirements for the CTC, which is kind of what I talked about when the kids are a little bit older. I have some clients who maybe take care of their siblings that are, over the age of, 19. So it's a little bit of money, right? $500 is better than nothing. 3, citizenship. The dependent must be a U.S. citizen, national, or resident alien. Residency, you and the dependent must have the same principal residence for more than half the year. Support, you must provide more than half of the dependent's total support during the tax year. 6, income limits. The credit begins to phase out when your adjusted gross income exceeds $200,000 for single filers and head of household and $400,000 for married couples filing joint. This credit is reduced by $50 for every $1,000 over these thresholds. And again, the tax software will always calculate that. So it's nothing we have to worry about calculating. Here, you will see where the child tax credit or credit for other dependents is calculated on the 1040, or where you can see that amount. So if you receive that for 2023, that is going to be reported on line number 19 on form 1040. So other dependents credit and child is reported on line 19. So make sure you remember that. Next, it's quiz time. We're almost wrapping up, y'all. Okay, we have a couple questions. All right, so this is a scenario. All right, Maria has 3 dependents. Her 16-year-old son, Alex, who qualifies for the child tax credit, her 19-year-old daughter, Sarah, who is a full-time college student but does not qualify for the child tax credit, and her 70-year-old mother, Linda, who lives with her and relies on Maria for support. Which of the following statements is true regarding Maria's eligibility for the credit for other dependents? A, Maria can claim the credit for other dependents for Alex since he is a dependent. B, Maria can claim the credit for other dependents for Sarah as she does not qualify for the child tax credit. C, Maria can claim the credit for dependents for Linda because she is a qualifying dependent. Or D, Maria can claim the credit for other dependents for all 3 dependents. So she's got her son Alex, who's 16, Sarah, who's her 19-year-old daughter, who's in college, and then her 70-year-old mother, Linda. So let's take a look and see what you have in the chat. I see a D, I see a C. Okay. I see a D. The answer is C. Maria can claim the credit for other dependents for Linda because she is a qualifying dependent. That is because Linda, which is her mother, meets the test for being a qualifying dependent. So she would actually receive the maximum credit of $500 for her mother, Linda, if she claimed her mom on her taxes. So when you see people kind of claiming their parents on their taxes, that's typically the credit that they're receiving. Now, also, you want to be mindful as well. I've seen situations where people are like, hey, can I claim my mom? My mom lives with me. Well, that depends. If the parent is receiving, Social Security disability benefits or something like that, that plays a factor, because sometimes those benefits, the way it's set up, like with the Social Security Administration, they may see it as the parent is living alone, and that's the money that they're receiving to support themselves, right? So if that's the case, then that parent can't be claimed as a dependent on their child's tax return, even if she is 70 and she's living with you or whatever the case may be, right? Because the Social Security Administration is like, hey, we're giving this person money. They do have a system, like some type of integrated system that flags those type of situations. I've seen it done before. So make sure that you are aware of that and take that into consideration. Next slide, please. Question, what is the maximum credit amount available for the other dependent credit? A, 1,000, B, 750, C, 500, or D, 250? Okay, I see C. That is correct. The maximum credit amount available for the other dependent credit is C, 500. Question number 3. Which of the following dependents qualify for the other dependents credit? A, a child who is 16 years old at the end of the tax year. B, an adult relative who is disabled. C, a dependent with a Social Security number. Or D, a child who turns 17 during the tax year. Question, which of the following dependents qualify for the other dependents credit? The answer is B, an adult relative who is disabled. So if you answered B, you answered that correct. Next, question number 4. What is the modified adjusted gross income threshold for single filers to receive the full amount for other dependents credit? A, 75,000, B, 100,000, C, 200,000, or D, 250,000? I see C's in the chat. Okay, looking good, looking good. The answer is C, 200,000. Correct, correct, correct. So that concludes everything for tonight. We covered dependents, our earned income tax credit, the child tax credit, the additional child tax credit, as well as the other dependents credit. So I hope this information was valuable to each and every single one of you. I hope you walked away and you learned something new. I do like to kind of stay consistent and keep things updated with the 2024 tax information. Now, I would say that, like, we're in September right now. Things can change. Sometimes, the IRS or like the government will decide that they want to, change some new tax laws or something like that. Just know that if and when those kind of things do happen, I like to, keep you guys updated and post about it, on my social media account, or we'll send out emails. If you're not subscribed to our emails, be sure to get subscribed to our emails. Now is our live Q&A. So if you have questions, be sure to type your questions in the chat, and I'm looking forward to answering your questions. Yeah, so all right, thank you. Very informative. You're welcome. You're welcome. I love it. I love what I do, y'all. I really do. I could talk about taxes like all the time. Where can we watch your other videos? So, this is series 2 of the Fundamental of Finances. So what I'm going to do is this series is going to continue throughout the end of the year. I'm going to kind of just take a look and see what type of response, that I get from the Fundamentals of Finance series. And my plan is to increase like the frequency of it. So right now we're doing it every other Thursday. So hopefully we can do this every single week. If you don't get to watch all of this or don't get to attend, you can always catch the replay on our YouTube channel. Let's see. So the other videos, like the one that we did last time, I think it was about like filing statuses and dependents. Again, y'all, my goal is really just to educate people. I see like a lot of stuff going on in these tax streets. And so I just want taxpayers to know and understand what's going on like with their tax return. I don't have to be your preferred tax professional. You don't have to want to decide that you want to start a tax business today, tomorrow, or next week. I just want to share the knowledge that I have so that, you can become more educated and you can educate others. So that's really just kind of, where I'm at right now. I just want to share the information that I've gained over the years. So does anybody have any questions? Tony, if you want to go to the next slide. So here, if you want to scan this is just my link tree. So if you want to go ahead and get registered for the next Fundamentals of Finance, like I said, I think it's October. Let me take a look really quick. It is October 10th. So it'll be every other Thursday at 7 p.m. Central. So also, if you have any questions, you can always, send us an email, contact@itaxinstitute.com. We have some information there for business grants. We have a link. If you go to my link tree, click on business grants. There's information, free information about business grants. Unfortunately, we don't have like a grant writing department at this time, but we will provide you with the information that you can research and you can apply for different business grants. If you're interested in me preparing your taxes for 2025, I do offer free tax quotes. So if you want to get on the list for that, there's an option for that, as well as let's see. If you want to start a tax business, our class starts next week. You can actually enroll at any point. I want to say I'm going to stop enrollment in December, the first week of December. But of course, the earlier you get in, the more knowledge that you'll be able to soak up, and your business will be where it needs to be. Starting a tax preparation business is not something that you want to wait until last minute. You definitely want to make sure you have the knowledge that you need. and you have all the systems in place. And I will say, I'm so thankful where I am now. I'm so thankful for my team. They definitely hold it down and keep me together. I am not a one-woman show. I promise you that. There are some amazing ladies that support me and support iTax Solutions that I don't know where I would be without them. So I started as an individual who didn't have any automations, any systems in place, all of that stuff, right? I was really just like figuring it out, like moment by moment, experience by experience, just, within my journey. And now I'm so thankful to see, where I am in the growth. So whether you are if you want to start a tax preparation business, that's fine. If not, it is what it is, but you don't have to necessarily have a team when you start out, because I know I personally did not. If you prepare your own taxes, I hope this information helps you, right? So here, if you want, I would appreciate if each of you can scan this QR code and take this survey. So what we're going to do is, if you go ahead and complete the survey tonight, tomorrow I'm actually going to announce the winner for the survey. So if you complete the survey, we're going to have a random drawing, and I'm going to give away a gift card. Okay. So I appreciate y'all's feedback. It really, really, really does mean a lot to me. So if you have some topics that you want me to cover, be sure to add that in the survey. Like, hey, Ambria, like I'd love to learn more information about, this topic, right? I'm going to also get into business credit and business funding. I'm not gatekeeping here, y'all. I'm really not. So I just want to, again, share the information that I've learned over the years, and the things that have worked for me, that have worked for my business, and things that I've helped other people to do. So again, be sure to scan that QR code, do that quick survey. I think it's maybe less than 2 minutes. And tomorrow, what I will do is I will announce the winner of a gift card. And whoever the winner is, either you'll get a call or a text message or an email so that we can get that over to you. It will be a digital gift card. So you'll have a couple of different options, what you want to choose from, whether it's like Amazon or Starbucks or Target. So yeah, you'll get a free gift. Thank y'all so much for tonight. I really, really do appreciate it. Again, next series number 3 of series 3 of the Fundamentals of Finance, we're going to cover the American Opportunity Credit, Lifetime Learning Credit. So those are basically education credits that you can receive if you attend college, right? Or you have dependents that attend college. And I'm also probably going to throw in some other stuff, because those topics, it won't take me very long to cover those. So I'm going to throw in some more gems as well. I think also I'm looking forward to doing like a W-4. A lot of people don't know how to complete Form W-4. So I want to actually do a withholding checkup. So actually, we may tie that into the next one, a withholding checkup, to make sure that you are getting the proper amount of taxes withheld right now, because you can change that at any time during the year. So if you're not getting enough taxes withheld, then we can help you to adjust that. And I also like to tell people, when it comes to that type of stuff, y'all, like, even if you're not getting enough taxes withheld, like, you have to decide, don't want a lot of taxes withheld to get a higher refund, or not get a lot of taxes withheld, potentially go exempt and get a smaller refund, or potentially owe, right? So there's so many different, caveats and things that affect that. But again, thank you everyone for coming out tonight. Be sure to register for the next Fundamentals of Finance free webinar series. Share this information with someone. And if you want to catch the replay, be sure to subscribe to our YouTube channel, and you can watch it there. Thank y'all so very, very much. Y'all have a great night, Tony. So yeah, so y'all be sure to complete that. And like I said, tomorrow I'm going to announce the winner. I will be attending the Woman Evolve. So Somewhere during the breaks between Women Evolve, I will definitely be announcing the winner. Y'all have a great night. Tony, we'll leave this up maybe another minute. If you guys have any questions, be sure to put them in the chat. Thank y'all so much for your participation. Y'all got a lot of these right. Good night. Good night. Y'all have a great night. Have a great weekend. Enjoy yourselves. Be sure to tell a friend about the free Fundamental of Finance series.